So, like most things, as Hemingway say, right, they start gradually and then they happen suddenly, which is why market moves at the end are always the biggest. My concern is not a recession or a shallow recession. My concern is that if we make these gigantic policy mistakes, which you have to put a reasonable non-zero probability on that then the economy could fall off a cliff.
Peter Borish, president of Computer Trading Corporation. It is so great to welcome you on the show. Thank you so much for joining me, Peter.
With pleasure.
Well, Peter, I want to kick things off with the macro view today, your assessment of markets and the economy. What is that big picture view for you right now?
Well, I think the biggest picture view is that we are in the early stages of a much longer rising interest rate cycle. And one could talk, I'm more technical than fundamental, but it's markets move when there's a combination of both. So we had this really long interest rate cycles. Following World War II, we had 38 years from 1944 to 1982, where we had rising rates. And like most markets, the largest move took place at the end, the last 2 years. Then we had a 38-year declining cycle from 82 to 20. And of course, the last 2 years, we had the biggest move to the downside. So now we're just starting. And if you look fundamentally, if you say, well, we should have 4% nominal GDP growth, 2% real interest rates, that would put the 10-year at 6%. And here we are at 425 to 430. So we're in the early stages. The issue for most people is they tend to anchor to what happened in the recent past. So they're like, oh, interest rates were low for a long time, so they have to go lower. Oh, this stock price was high. It's come back down. It's got to go back up. No, it doesn't. That's not how markets work.
Yeah. It's because we anchor to I guess we have recency bias and whatnot.
Absolutely.
Yeah. Yeah. You were mentioning, this is interesting to me, these kind of 238-year periods from, call it post-World War II until 1982, and then from 82 until 2020, with those big moves happening right toward the end. A lot of folks have kind of, and maybe they've analogized this time period to the 70s, but if you had to look back in history, is there a time that you see it being more analogous to?
So I think it's very important, and this is where sort of my Fed and economic historian comes into play. This really isn't the 70s. The 70s, inflation took place because the Fed chairman I mentioned earlier, that Greenspan was the new Fed person before Volcker. Before Volcker, G. William Miller, when we had the energy shock of the Yom Kippur War in 73, tried to monetize that rising oil prices, and that led to a rising price level for everything. And as Milton Friedman said, right, inflation is a monetary phenomenon. We are not in that environment, right? We have the Fed that is not introducing more liquidity into the environment, and prices are relatively driven. So we're not seeing a general price increase. At the same time, we're seeing a huge monetary supply increase. So fundamentally, this is very different than the 70s. Now, of course, it's easier for most people to make a comparison because that's a decade that everybody was really worried about inflation. And we had that acceleration towards the end of the decade, as we were talking about, in interest rates. But if you look at gold prices today, if you look at silver prices today as proxies for that, they are not going up in the way that they were in the 70s. In addition, we had other supply shocks in the 70s, Russian purchases of grain. So you had supply-demand dynamics that led to rising prices. We are not, in my opinion, in that kind of scenario today.
Yeah. So you think it's more like do you think it's more like post-World War II then?
I do. And again, here's a simple way to look at it. In World War II, we fought a war. We financed it with government debt. We lost a lot of people. And needless to say, bombing caused a lot of supply chain disruptions. During COVID, we financed it with government debt. Unfortunately, we lost a lot of people, and it led to massive supply chain disruptions. Then you look at what monetary policy was after World War II into today. And one way, so we had a very high debt to GDP ratio. The Fed tolerated a little higher inflation for longer. Why? Well, that reduces the real value of the debt. Rising wages push people into higher tax brackets, which then, and higher wages too, which is a good thing. That provides more revenue, which reduces the government debt to GDP ratio. The one thing that's absent today that was really interesting post-World War II is from that period to the middle of the Eisenhower administration, marginal tax rates went up significantly to help close the debt to GDP ratio. By the time President Eisenhower was there, the marginal tax rate was over 90% for upper income people. And so I always find it a little interesting. And then it was President Kennedy that reduced the first marginal rates. And then, of course, it was Reagan. And when Reagan reduced them to 50%, everybody was throwing a party. Now we're having this huge political argument. Oh, should it be 36? Should it be 39? I don't see that the case. But that's a whole other political issue. And I always have to disclose that I'm a Democrat that believes in markets. So if we want to go down that route, I'm more than happy to.
Yeah. Well, what do you think would happen if I don't know if you think it's going to happen, but is that like something you have to kind of think about when it comes to these markets, that could be a possibility? Do you see it as a possibility, raising taxes?
Well, they've gone up some under the Inflation Reduction Act. And if the 40 million or the 400 million is paying taxes, the notion that, oh, well, they may not work as much because their tax rates go up, I'm kind of like, they don't have to work now.
Yeah.
You know, if your tax rate goes from 36 to 39, that's not going to change your behavior. I've never met an entrepreneur, all the VC funds that I advise that go, oh, I'm not going to do something because of where I think my tax rates are going to be. So you adjust for that. But I agree. The 400,000 person who's making that money should not be paying the same rate as someone that's making 4 million or 40 million. And if there was more sense of fairness across the board, that would be beneficial for the economy because it would help reduce the debt to GDP ratio. If you look at, government spending as a percentage of GDP, that hasn't gone up so much. What's gone down significantly is revenue relative to GDP. Like most things in life, you need better balance. Your personal life, and in this case, our government's economic life.
Yeah. I want to ask, I just want to hear your perspective on like the debt situation in the US. How do you think about that? Is that a worry of yours? Just want to hear your thoughts because it does come up quite often on this show with guests.
Well, again, as an economic historian, we've always been, people have always talked about debt. You can't look at it in isolation in absolute terms. You have to look at it relative to a growing economy. And are there solutions to it? I just mentioned part of a solution, which is changing marginal tax rate. The issue in my mind, again, is not spending. It's revenue. Now, yes, you could talk about spending with regard to the changing population dynamics because of Social Security and Medicare. But I also think there's a way to deal with that as well. That's a very regressive tax, as you know. So if the maximum cap on paying Social Security is $160,000. So that, if you make that much money, it's 7%. If you make more than that, every dollar you make, that marginal tax rate goes down. So to me, a solution for that would be to have a donut and say, okay, between 160 and we'll call it 500,000, you're not paying additional taxes. that would be a solution over that to pay more taxes or restart your Social Security, Medicare taxes. That would be the equivalent of what I was just talking about, which is raising marginal tax rates for those who are making more money. There are solutions. It's a question of political will. On the flip side, if I can get a little wonky for 1 second, for benefits for retirees, if you have a high inflation rate, they make more money because benefits are tied to the CPI. The funny thing is, it's workers that pay into that. So the real benefits for retirees should be predicated on what workers are making. So if their wages are going up, retirees should get a wage. If inflation is going up and the real wages of workers are going down, that makes it worse in terms of this imbalance. So I think it's an intellectual discussion. It can be driven if we get out of, on both sides of extreme ideology.
I actually haven't made that connection until you just brought that up. That's fascinating. That's an interesting point. And one of the reasons I love the show, because we get to explore new ideas and think about these things.
You can always count on me for insignificant information.
No, that's not true, Peter. But I do want to go back to discussing, as you mentioned on your big, like more of your macro picture, that we're still in the early stages of a long interest rate cycle. I want to hear more on that. Do you think, because you're right, you pointed out the 10 years at 4.25. Do you think we're headed to 6%? What are some of the implications of that? How should we be thinking about that?
So just to be clear, markets don't move in a straight line, as I said earlier. If you look at that move from 82 to 20, where rates were going down, 50% of the months or so, bond futures were going down, which meant rates were going up. But the months that they went up, right, they went up more than they went down. So it's hard to hold a position, and it's not going to be super consistent, and it's not going to be really quick. So the implications for that are that I'm hoping that it leads to better balance economically among those who are workers, who will be rewarded for their working, and those who are not working, in the sense of, the policy should not be what is the level of S&Ps. So the S&Ps on a number of metrics are, overvalued historically, and I think they're going to go back towards the mean. So wages should go up, rents being in the equity market will go down. That's the implication, because the substitution value being in interest rates will go up. So what I refer to as, you've got these two retirees and they go on the golf course, and in the morning they're not working, and they think that it's their God-given right that by the time they leave the golf course, they should make more money because the S&Ps went up. That's not the case. You should not be rewarded for simply saving and not working. Actual workers, the people that are your caddy, the people that are treating you on the 19th hole, they're the ones that should be getting more rewarded for their economic rents and for saving, which they will with higher interest rates.
Yeah. Do you think we'll see wages go up?
Yes, I think we have seen wages go up, and we'll see them go up more. Again, part of the issue is supply and demand works. And when you have a policy where you're not encouraging immigration, which is usually young workers coming in who are taking lower wage jobs for a lot of people that don't want to do them, you'll see that means that they're going to have to raise wages to fill those jobs currently. It's interesting, everywhere you go, whether you're in Carolina, in New York, if you're a customer-facing business, you need more human capital to work. There's a clear shortage of that. And the way to solve part of that shortage is to raise wages.
Yeah. Yeah. I just was wondering too, but do you think the market, do you think the market's going to go down?
Well, markets go down, markets go up. In terms of relative prices Do I think that the S&P is likely to move down from here? Yes, because again, there's a much better alternative now, which is higher rates and which is less risky. And the fact is that you're getting a squeeze on some corporate profitability because their input prices are going up, energy prices are still high, and you need to pay higher wages. And at this point, with measured inflation coming down, it's going to be more challenging for them to raise prices. So I think there's going to be a little bit of a profit squeeze, which will drive prices down. Of course, everybody asks, well, 87, is there going to be another crash? And I'm like, yes, but probably not for another 20 or 30 years.
Yeah. I'm sure you do get asked that quite a lot, like because of the 1987 crash.
There's an old saying in the business: if you're bearish, you're never wrong. You're just early.
There you go. Well, so are you bearish?
I am. There's a difference, I think, between cautious and bearish. I am not like really bearish here, unless we have tremendous policy mistakes, which is possible, right? If the government gets completely shut down because of, again, the ideologies coming in and not passing all these appropriation bills, and we get shut down in August, and that leads to a shorter term spike in interest rates and an economic slowdown, that would make me bearish. But right now, I'm cautious. Mm-hmm. And coming back from Labor Day, that can change significantly depending what happens in Washington.
Yeah, that's a good point. How about I don't, because you're cautious. You mentioned you're cautious. Do you have any sort of outlook or expectation or maybe even probabilities of a recession, or what that if we're going to have one, or just would love to hear your thoughts there?
So like most things, as Hemingway say, right, they start gradually and then they happen suddenly, which is why market moves at the end are always the biggest. My concern is not a recession or a shallow recession. My concern is that if we make these gigantic policy mistakes, which you have to put a reasonable non-zero probability on that then the economy could fall off a cliff. Because if you look at what's so important in terms of for people, again, I keep going back to this balance term, right? Private sector, public sector, international sector. If we close down our public sector for any length of time, that's going to really put it a much larger imbalance, and that could slow the economy significantly.
Yeah. I guess like for right now, for the environment we're in, what is interesting to you? Where are you seeing opportunities? What are you trying to avoid? Just would love if you would be willing to share, how you're thinking about this market environment.
Well, I think you have to look at the stool, right? You've got the international, which we haven't even spoken about, right? So a few months ago, everybody's talking about Ukraine and Russia, but it's still there. That is a potential accident waiting to happen. You have political uncertainty in Africa, the potential change in Argentina. You have the implications of Brexit just starting to flip through the real economy. So you have Britain and UK. So the engine for growth has been the US. So I am really thinking about the sense of, if we come out of the summer, and I'm going to harp back on it again, and the government is shut down, I don't see where marginal growth is going to come from. So that could significantly change the yield curve. Maybe the Fed wants to put in more liquidity, but it's going to drive longer term interest rates up. And you can see that, by the way, if you look at like the ETF, TLT, how that has really broken down. So at this point, right, this goes back to the notion of risk management. There's nothing really clear to say I should be taking on risk assets. If I've had a good run, there's nothing wrong with reallocating and taking profits. And that's the hardest thing in the world to do. So if you've been long NVIDIA, you've been long Apple, fantastic. But rebalancing your portfolio is something, and by the way, right, the NASDAQ did that by doing a rebalancing of the NASDAQ 100. It's not human nature to do that, but that's what's necessary, and that's what I would recommend right here. And by the way, the other deflationary aspects that you're seeing, the dollar has continued to be strong. Look where dollar yen is. Look how much off the high the euro is. Some of these other currencies like Aussie dollar. So the markets aren't telling us that we're in an inflationary sort of scenario. And it's telling us to sort of be cautious, because when the dollar gets a lot stronger, the S&Ps tend not to do so well.
Peter, you mentioned risk management, and I know this is such an important area for traders. And as someone who's been in this business a long time, just curious, especially maybe, sharing with those who are watching and listening, what do you think is the biggest mistake that people make when it comes to risk management?
Well, first of all, experience is the best lesson. I always tell young traders, I've lost money in every imaginable way, and I'm sure there are new ways that I'm going to lose it. But in this business, if you survive, you win. So the key for risk management is taking your ego out of the equation and admitting you're wrong. That's the hardest thing. We are trained our whole lives to be right, to win. And in the trading world, in the short run, and I learned this from Paul, who's the best, is you may get me today. That's okay. But I'm going to get you back tomorrow with a very high interest rate return. You have to be willing to take the loss today to survive and be in a position to participate in the markets tomorrow and the next day. And if you have too large of a loss and you get out of that position, you mentally feel great, right? Because you don't have any more risk. But if it's too large, you don't want to get back in the game. You have to keep your losses small so you can suffer a losing streak. No matter how great you are as a baseball player, you're going to go 0 for 15 at some point. But you have to believe that the 16th time you get up, you're going to be successful. You have to have a series of small enough losses that you can continue every day to get up to the plate.
I love that. It's such a good reminder too. Maybe just in your career, was there ever did you ever have one of those learning moments or I'm curious, teachable moment or a mistake that you learned from that stands out to you?
I've had so many mistakes, as I said before. That's part of the business, and if you're in long enough, you're going to have new mistakes. But I think that for me, one of the biggest learning periods was literally, and I was still at Tudor, and I was head of research, and then we developed these models. We were sort of the first early sort of quant, which I did, which we called Tudor Systems Corporation. And going into the Iraq War, we said, you know what? We're not going to really trade here because this is the first time in history that the president, and this is Bush, sort of announced a market, when the starting date for war is going to be, and we can't get our arms around this. And instead of just trading smaller and having less risk, we sort of stayed out of the market. And of course, there were gigantic moves after that, and we missed them. So sometimes you can't win. You can be too cautious or too risky. But in that case, we didn't follow our models, and we had done a lot of testing, and we should have stuck with our discipline and followed those models.
Yeah. But I appreciate you sharing because it's helpful. And you've had a long career and a lot of important lessons. You mentioned working with Paul Tudor Jones, for the folks watching and listening, at Tudor Investment Corp. And you and I were talking earlier just about your career and how you got interested in this space. Would love to hear that story. What was it that made you want to get into markets, and how you got connected to Paul Tudor Jones in those very, very early days?
So I'm going to take that in two parts. The first thing is, when you trade or you do something, you have to trade your own personality. And we try to learn from other people. You can't trade like me if you don't have a similar personality. So the Tudor way is small losses, always be close to new high ground. Now, there are other strategies, right? Trend following strategies that are a lot more volatile, but when there's an outlier, they make a lot more money. That's not our personality. Now, I was very fortunate. So I was at the New York Fed for 3 years after graduating Michigan. And Paul was the chairman of Finex, which was the new financial futures exchange of the Cotton Exchange. And I had worked at the Fed in a new group there, financial futures and options. I think you have to recall that the S&Ps just started in 1982. And crude oil futures started in 85. So these were all new. Through a headhunter or somebody that Paul knew, they found my name, and we met and we got along. And I said, holy cow. He offered me an opportunity to join a startup. And literally, it's like that was the startup of sort of the hedge fund industry back then. And my parents were a little, shaky, because it wasn't who's this guy, where I could have an opportunity coming out of the Fed going to a brand name firm. But I was 25 and I thought, well, if you don't take the risk now, you're never going to take it. And knock on wood, I guess it worked out okay.
I think it worked out more than okay. What a great decision for you both to be connected. And that's an important lesson. And I know you do some VC, and I imagine you talk to young folks, and I imagine you talk to people going to the startup, such an important decision versus, maybe it's like the parents want you to go for one of those more established Wall Street firms, if you will. What kind of advice do you give to young folks today? Like, go take that chance early on in your career.
I try to be true to myself and not look back on revisionist history. And so I think that's partially very important when you approach markets, right? You've got to step back and you have to be very sort of self-aware. And I think that that's part of the advice, that you want to do this and you want to take that opportunity, but you also don't want to be the person when you're in your mid-30s sleeping on the couch on your friends in the friend's basement saying you're going to build the next great app. At 25, 27, yeah, it's a tremendous opportunity to go ahead and take that chance and fail. But like everybody, they all think they're going to be playing in the NBA. And that's fantastic at 10 years old. I still want to play in the NBA. But that's not going to happen. So you have to realize at some point, do you have that chance? Do you not? And so take that, spend all that time on the court, spend all that time innovating in VC, but the marketplace is going to tell you whether or not you're going to get to the next level. So what's the marketplace? Can you raise capital? So most people, you have friends and family, you can get started. But does the real VC community validate that idea? And if they're not going to validate that idea, you either need to go on to a new idea, which is okay, you can fail, or then you should try to go and take the skills that you've learned and apply that in a more traditional working environment.
Yeah. So going back to joining Tudor in 1985, and you were mentioning just some of the pioneering work that you all are doing. That futures were so early. It was when futures were coming around. 1987 was, you all had you all did really well. That's a light way of putting it. In 1987, Black Monday, the crash there. I would love to go back and talk about the events leading up to 1987. What were you all seeing in your models? Like, what do you remember about that time and that day that, stay with you even now?
Well, I think, like most things, trading is sort of built on confidence. And Paul was willing to invest in data and technology and supported sort of my crazy vision of what was happening. And we spent time and money at that point taking data, typing them in spreadsheets, running all sorts of regressions, doing a model, and thinking that what was happening post the low in 1982 was equivalent to post the low of 1921. And I keep harping back, as I've said repeatedly, the largest market moves take place at the end of the move, not the beginning of the move. And if we want to go back to January of 87, we had 13 straight up days in the Dow, which, by the way, we just had now, which led to this current short-term top. I don't know if it's the top. It was not the top in January, but it said there was a lot of strong momentum. So the model was following that. And after the top in August and the secondary test in October, the best way is when the fundamentals and the technicals intersect. The fundamentals of rising rates, which is where we are today, but they were much higher then. Political international conflicts, which we saw with under Jim Baker and German, and the dollar was an issue, which, so these things all, history rhymes. And so we put that in place. And Paul, being a tremendous trader and risk manager, was able to put the position on. And as I said, Friday the 16th was an expiration Friday. And part of it back then is, again, the markets were not as integrated and linked. So there was far more dislocations. And coming into Monday, you had this new strategy, which everybody talked about, portfolio insurance, which was the ability to trade futures and stay long stocks. You could hedge that. Well, clearly, when you had a big down market, you had cascading selling effects in futures, which then ultimately led to more selling in the cash market. And since they weren't as linked, you had these air pockets, and that led to a tremendous decline.
Do you remember what it was like that day? Do you going back, just just take me back to that moment when all of this was going down? What was that like for you?
So I think you got to separate the intellectual from the emotion. Mm-hmm. Intellectually, it was like, wow, that's fantastic. We had the model. It's working. We have a position on. We're making money. Emotionally, for me and for Paul, who's a good guy, and that's one reason why, we started Robinhood. Nobody really likes to make money, because we never thought it was going to go down that much in a day, right? That was a historically large decline when others are suffering. And so, by Tuesday, we were totally out of our short position, and we got long fixed income because we felt that Greenspan was going to ease monetary policy and rates would decline, which they did a lot fairly rapidly. So that was the mixed emotions. Yes, it felt great as a young guy, to sort of be, wow, I'm vindicated. I'm pat myself on the back. Okay, that lasts. But then you start thinking about the challenges that others may have in a situation where the economy and markets turn down. Now, fortunately, the economic decline was not nearly as large as we thought it was going to be. There was the resilience, there was policy support by that time, by the end of the Reagan administration and the new Bush administration, and the markets recovered fairly quickly, and GDP didn't go down as much, and we were, very, very pleased about that. But that was the impetus to starting the Robinhood Foundation, which is probably the largest private now foundation in New York. And that first year, we gave away less than $65,000. 34 years later, 35 years later now, I guess, last year, we gave away over $150 million to 220 not-for-profits, direct service organizations in New York City. And I look back on that and I couldn't be more proud of anything I've done in my life.
Wow. Yeah, and so interesting. Like when you say separating the intellectual from the emotional, and that being the impetus to start Robinhood, which has done incredible work in New York City, to say the least. That to me, like that's fascinating. It really struck a chord, and because I think you were saying like y'all were anticipating like maybe the economic fallout would be worse, but you mentioned the policies that stepped in and whatnot, and the resiliency of the economy. But let's talk about Robinhood. You said that's one of the things it's one of the most impactful things in your life. Would love to explore that a bit further. And if you just want to share more about some of that work. And I love that you're still involved to this day with Robinhood.
So Robinhood is all about mobility from poverty. And it tries to take a holistic approach. It's a very challenging problem, because if you have substandard housing, if you have substandard healthcare, and you're not in good schools, it's all going to be difficult to have mobility from poverty. And it's a multiple generation issue. Yeah, you could try to have, and we were the first supporters in New York City of charter schools. You could try to deal with education, but if your parents are being challenged, or they're not there because, let's say, they're working an overnight shift in healthcare, you need to provide a comprehensive set of resources for individuals to try to move from poverty. And that means a sustainable workforce effort, sustainable housing effort, sustainable education effort. In sort of the glue is sustainable, food. So we do across the board. We're large funders of food pantries. If you're a kid and you're in school and you're hungry, you're not going to be paying attention. So it's a comprehensive approach, and it's a slow, serious, methodical approach of dealing with mobility from poverty.
Peter, I know you're sitting in New York City today as we talk. What's your assessment of the city today? Just curious, just want to hear more from where you sit. What do you think needs to be done? I imagine you probably have a view on, return to the office, especially for younger folks who are starting careers and moving to the city. What's kind of your big picture take of New York City today?
Well, New York is, in my mind, the greatest city in the world, and cities in general have the infrastructure to move forward. Young people want to be in cities. They don't want to be sitting in traffic and commuting. They want to be around other people who are young and smart and challenging themselves. And that's why cities thrive. And you see, sort of a temporary movement away from that. But I don't know any young person that goes, gee, man, I want to start my career and be in the suburbs. It doesn't work that way. So are there policy challenges? Yes. And, you look, people were like, oh, wow, there's a lot of migrants here in New York. Well, there's been migrants in New York for hundreds of years. I'm Jewish, and you had the Lower East Side when you had that coming in the late 1800s and 19. And yes, what were they selling? They were doing the same thing. They were selling things on the street. They were trying to have a better life for them and their kids. And they provided, as we said earlier, the impetus for workers went into the economy. and the next generation gets smarter and more integrated, and the generations after that become leaders. So is it in the short run a challenge? Absolutely. Am I bullish on cities? Yes. And am I particularly bullish on New York? I am, because the greatest human capital in the world and the smartest young people come to New York. Human capital and intelligence is a good way to solve problems.
Yeah. Do you worry about work from home and the lack of mentorship in that scenario where you don't get that FaceTime, you don't get to, is that something that kind of worries you or you think about, especially for the younger folks getting started?
I don't know if I would use the word worried. I would say that people, it's like maybe a capacity question. When everybody's out of the office, it makes sense to be out of the office. Slowly but surely, more and more people will be in the office, and that marginal person that's staying out of the office is going to do what you just said. They're going to be losing mentorship. They're going to be losing connections. And then they're going to be like, oh, I need to go to the office as well. There are very few leaders out there, but the leaders come and others will follow. And I'm fairly confident that there'll be less and less work from home. Now, is there going to be better life balance? Sure. Maybe you're going to have a floating work from home, maybe on Fridays and in the summer. But you kind of always had that, right? You had summer Fridays in certain industries. So, and technology is a great thing. Right? We're here on Zoom and it's like we're right next to each other. So there's been benefits from that. But I think the downside has been, as you said, lack of mentorship. And I think the marketplace itself and competition will handle that. And there'll be more and more people in the office.
Yeah, I do miss like the human connection. I'm not going to lie. But yeah, I do. We have a few moments and I kind of want to go back. I want to go back to 1987 because you were a young man then and you were the second youngest on the Brady Commission. I want to go back, talk about that experience and some of the key learnings from that stand out to you the most, even today, that are relevant today. Can you talk about that experience?
So I'm still friendly. In fact, at one point I said I was the youngest. And then my friend reached out to me and said, no, that's not the case. I was the youngest. So even all these years later, there are still friends from there. When you were in an intensive short-term work environment, you know, it reveals who you are. And I was, no question about it, right? That's all I did back then was work. I love markets. Even today, I love markets, people, and politics. And that experience and having mentors, right? Bob Glauber, who was a professor at Harvard, and David Mullins, who was the chair and the co-chair. They were, to me, the old guys. Now I'm the old guy. And I always was willing to learn from them. And even though I was young and thought, wow, and also we had success at that, I'm really, really smart. Tudor had all the data. We were way ahead of the rest of Wall Street on that data for the market break. And so that made me feel great. But these people who had more experience with data, they're the ones that were able to weave the correct narrative in the story and pull it all together. And that was the greatest conclusion of the Brady Commission, was that all these markets are linked. New York, Chicago, Europe, and you can't look from a policy and regulatory perspective and treat them in isolation. And that's where the presidential task force on market mechanisms was born, out of the Brady Commission.
Yeah, that they're all interconnected as well. Yeah, I would imagine like a fascinating time to work on that and all the data that you all provided. We should talk about Paul Tudor Jones as well. I want to hear about, was there anything that you picked up on over the years, maybe some traits from him that you kind of are like, yeah, that's what makes a great trader. Any sort of insights about Paul that you want to share with the folks who are watching and listening?
Well, the first thing is, there are a lot of people who've had tremendous success and they change. And that's not Paul. He's still true to himself. He's obviously wealthier, but he's, sort of the same person now as he was back then. And that's why people like him. That's why you haven't seen, stories in the press. And you can tell to a certain extent because his children are very well grounded, independent. And so I admire that. And I think that's a trait. And I'll say one thing that in terms, not only was he an innovator in markets and research and supporting that, but one of the other things that he was really an innovator is, so he got married in January of '89. I got married in October of '89. His first child was a girl. My first child was a girl. And I remember in the early '90s talking to him one afternoon, and you had that whole Wall Street culture. And he looks at me, and this is what makes a great leader. And he goes, "We got to build a firm where we would want our daughters to work." And I think that was early on changing the entire culture of the office, the trading desk, and how that was. And to me, that just says a lot about Paul and the nature of the firm, which I'm not involved with on a day-to-day basis. Most of my time with Paul is spent, working with Robinhood, and that culture today. And I think that's a really proud moment.
I love that. How about when it comes to, I love that. And I love the character side of things. Now, I've had the fortune of interviewing him before, and I would love to have him on this podcast at some point. And you're right, he's phenomenal and great character. On the trading side, anything that you picked up over the years about like what makes a great trader?
So there's many a time where, we were having these systems and developing, and I'd have a bad day, and I'd go down to, sit on the couch in his office. I'd put my hand on my head and I'm like, oh, why the hell am I in this business? And he'd be like, hey, this is the life you chose. You can get out of it and you won't have all this emotional agita, but to succeed, you have to be mentally strong. And I learned more about that. And that's what we talked about earlier. That's all about risk management, right? In this business, when you're making money, you're like, I'm always going to make money. I'm so smart. I'm always right. And then when you're in a losing streak, you're like, why am I here? I'm never going to be successful. This is the dumbest thing I've ever done. The reality is in between, and you have to stay grounded. And I think the great traders are grounded and understand that. And having that support, if I didn't have that support from Paul in the early days, I don't think I'd ever have been able to go out and do it on my own.
I love that, staying grounded. Well, Peter, I want to give you a few moments for some parting thoughts. Anything that we didn't bring up in this conversation that we should, parting thoughts for the folks who are watching and listening, and let folks know where they can find you on social media, follow any of your work or anything that you want to plug. Go ahead and do so.
Well, I'm on X, but I don't really use that much because I'm trying to be very cautious of what I say. At P. Borish, I'm sort of more on LinkedIn. And as far as parting thoughts that, I have, when I give a talk on trading, I have sort of one slide on risk management, which I think is important for people to remember, which is never minimize the pain when looking backwards from a positive outcome. Because you think when you look back, oh, it's okay, I can handle this volatility because I'm always showing you at new high ground. But living through it is something else. So my advice is trade smaller, admit that you're wrong, and survive to trade another day. And I always end the presentation with the slide, if you survive, you win. Most people, whether they're athletes or traders, they leave after they've had a really, they can't do what they did before, or they've had a bad losing streak. Try not to do that. Take some money, take some profits, and step back. And more importantly, clear your head, because your self-worth is not predicated on your last trade. And that's also very, very important, because we think about that. You have a bad day and you walk around and go, woe is me. And at one of the Robinhood benefits, Paul said, he goes, you guys should be giving, and you should be giving more, because the people who we support, your worst day is still a lot better than their best day. And if you keep that in mind, you'll have a better approach towards trading, others around you, and life in general.
I love those principles. Peter Borish, president of Computer Trading Corporation, thank you so much for being so generous with your time, your ideas, your lessons, your principles. I really appreciate you coming on. Thank you so much, Peter.
Thank you. And if Michigan plays Carolina, I want an invite.
Yeah. Thank you. Have a great season as well.